Good morning or good afternoon, depending which side of the country you're joining us from. Charley McQueen, President McQueen Financial. I'm super excited to kick stuff off here. We are super fired up. And yep, there is a mistake on the screen. It does say 2 p.m. I apologize out there. It's starting at 1. Don't pay attention to my screen. How about that? So, hey, sorry about the little bit of misinformation there. We are running and we are good to go. I'm excited. CECL is live in less than 90 days. So a lot of stuff going on. Just for everyone to know today, if you do have any questions, feel free to click on the Q&A button at the top of your screen or the side, and I will go through and answer those questions along the way or as we get to the end, whichever is appropriate. As usual, we are recording this webinar. It'll be available on our YouTube channel. You can also reach out to your advisor and we'll get that information to you. So super excited about that. I'm sure you guys well know each other now. Thank you for joining me today. I'm just excited that we've got our three core service teams, our investment advisory team, our asset liability management team, and our valuations team all here. Great group of people. I'm really, really fortunate to work with some amazing people. So with that, we're going to kick off and talk about CECL. I know we've got an hour set aside today. It's not going to take the whole time, but this is a really important one. So I really hope you guys can pay attention here and hang out with me for the next about 40 minutes or so, 35 minutes, because CECL is going full speed. And we're excited about rolling out our new CECL platform, which is really cool, but we're excited about CECL being full speed, something that's happening today and really important. So CECL, just to give the basics for everyone, it's the replacement for the allowance and loan lease loss calculation, the ALLL. All institutions, banks, credit unions, investment firms that are buying loans and things, everyone has to follow the same process. It's a way to get everyone equal for their allowance effectively, so their CECL numbers are consistent. It doesn't matter what type of industry you're in. CECL, the goal of CECL is to look forward and say, what are my problems? What are my losses going to be? Now, here's my historical losses, but let's look at those historical losses and look at where we are in a cycle, an economic cycle, where we are in process. And hey, if we can look back and see where we were at a different point of time that was similar, and use that to project losses, that is our goal. So it's forward-looking, but it does use historical data. CECL does start on January 1. We're going to go through that in a second here, but we do need to have an initial CECL number on January 1 of 2023, which means December 31 of 2022, 90 days, 3 months from today, we need to have our CECL transition number, which we'll talk about. So why are we doing CECL? Well, we've got all the data already. And we also, you know what we need to do CECL and ALM reports. So it's not a requirement yet, but we see in the future that as we look at our plus minus simulations, that we're going to have to modify our CECL number based off of the economic environment that we've forecast. So it's got to be an ALM, so we felt it's important for us to do this. As we start off with CECL, CECL is modified by 2 different groups of modifications. The background of CECL, the actual loss numbers are factual. Here's how much I've lost in a particular product line, my historical losses, and that's a factual number, but then we modify for going forward. And those 2 modifications are fairly simple. Excuse me. The first one is a set of economic factors. And those economic factors, we use the change in unemployment. The unemployment rate is one of the baseline components, which is considered right now the most relevant ability to predict future losses is unemployment rate and the change in unemployment rate. And so we monthly and quarterly sit down and go through all this analysis and come up with what we believe is an appropriate CECL global economic modification. And we then put that number into all of our reports. So it's important that we're looking at a forward economic number. Now, of these 2 areas, this is the smaller of the 2 areas. The bigger the area, the current conditions adjustments. Now, this is a big section. Current condition adjustments are something that there's lots of debate and conversation around, and I want to make sure that we clearly talk about this. So current condition adjustments, what are they? Well, they are things that are unique to your institution. They're unique to your bank, unique to your credit union. What do you see happening to your entity? Now, this is something that we'll help with and help you kick off, but this is something that you're going to have to do on a monthly basis. Just like you do the environmental factors for your allowance for loan and lease loss calculation, we need to do effectively the current condition adjustments or environmental factors here. We recommend a minimum of 4% of loans in non-accrual status. If your non-accrual is going up or down, that should be a good forecaster of losses. Percent of loans delinquent 60 days or more, that should be a good indicator. If that's going up, we need to reserve more. I'm going to go to the bottom, remaining weighted average life. Now, something that's been really interesting here. If you have a number of mortgage loans on your books, let's just say a year ago, they were 5 years in duration. And now, because prepayment speeds have fallen so much with rising interest rates, they're 8 years in duration. Your risk has not gone up substantially. And a lot of people would argue your risk has gone down because the home values are up. And so we can actually make an adjustment based off our weighted average life going up a lot. And when you're using the weighted average remaining maturity model, the WARM method, what that's doing is that would cause your reserves to go up. And we've seen this a lot with a number of you who've been doing CECL with us for a couple of years or a year and a half now. You've seen some of your reserves go up based off of the duration or the weighted average remaining life of loans going longer. So this will be a spot where we can put an adjustment in to normalize that and remove that increase that's happened because of prepayment speeds getting lower. Now, the fourth one here, really important, is the regional or specific conditions. And this is something that is a pretty wide open area where we can put all sorts of different adjustments in place. But it's important if you have a specific condition. Let me give an example of this. We have a client that was involved in indirect lending 4 years ago. And farther back than that, but up until 4 years ago, and 4 years back, they realized they had the wrong people running their indirect program. They were making bad credit decisions. Now they removed all those people and changed the entire program around. So if we look at the long-term history, it's showing this really high loss rate, but in reality, we've made substantial changes to the underwriting factors, the underwriting quality, the people managing that business line. And so we're actually able to put some negative adjustments to reduce the allocation of the CECL reserves to that product type because of what's happened. Additionally, some of the other things we've seen in this is that there's people have had where their region has been acting differently. We had in the Ohio region the shale oil boom, where we saw lots of places doing really, really well, and delinquency dropped substantially. So that could be a regional condition that someone struck oil in our neighborhood and we all are getting royalties from that. So a lot of different things can come in here. Maybe you're on a coast. The coast acts differently than other parts of the country. So you can put in these specific conditions relative to your institution, such as lending practices changing. You can also put much bigger things there, such as regional activities. Here's what's happening in our region. Our population's growing, things are really good, or our population is shrinking. These modifications are extremely important. And this is where we have the capacity to smooth our CECL numbers, increase reserves, and really to properly make sure we're setting aside the right dollar amount. Not smooth in a bad way. I want to remember that. If you think about WARM, the duration extends when prepayments decline. All of a sudden, our reserves much higher. This would allow us to keep it at a reasonable amount. And conversely, if prepayment speeds go up, that duration may drop down really fast, but that also may mean that we're in a tougher economic environment. We should reserve more. So we can use these adjustments in many ways, and this is what they're designed for. So really excited, super important area. We're going to go through some examples in our online system here in a couple minutes. So with all the things that are happening here, the call report has to change. So the call report has to change because of CECL Day One. And starting with the December 31 of 2022 call report, there's going to be a new line item, at least one, and it's going to come across the initial CECL amount, the initial CECL transfer amount. And so it's going to show up here. And so we have to, again, run this December 31 report to give us that initial number to put in here. Also, there are adjustments to how net worth is calculated for credit unions and how Tier 1 is calculated for banks, because the full effect of CECL does not hit our capital ratios immediately. So to be clear, let's go through CECL Day One. So as we kick off on CECL Day One, which actually starts on January 1 of 2023, we need to determine the initial CECL amount. And when we do this initial CECL amount, and this simple example will be, is that an institution currently has $2 million in their allowance for loan and lease loss, and their CECL number that's calculated on January 1 of 2023, or we could say December 31, 2022, we're using that report, is $3 million. So the CECL number is $1 million higher than the current LLL amount. We do expect that most CECL numbers are going to be a little bit higher. This is a 33% or 50% bigger. It's a big number, but for this example. But that $1 million becomes the CECL transition amount. Now that CECL transition amount gets put into our December 31 call report, along with our CECL number. Now what's really important here is the CECL transition amount does not flow through the income statement. It doesn't flow through anything. What ends up happening is we then do this transfer out of reserve to our CECL, but our capital calculations, or regulatory capital calculations, net worth and tier one, do not include this. And there's a schedule of how this happens. So really important, we need to be very quick with our data. We need to make sure that we're getting all of our data from you on a very timely basis, especially at year end, because you won't be able to do your December 31 financials or your December 31 call report until the CECL calculation is completed. And then on a monthly basis, starting with January month end, we have to have your CECL data and your CECL number back to you to close out your January financials. So a lot of things have to happen very, very quickly now at month ends. So let's talk about what happens after day one. So for credit unions, it's a little different. For credit unions, for year one, first 4 quarters, there's no capital impact. And so there's nothing that happens. And what we end up doing is the net worth calculation brings back the initial CECL transfer amount. And so we bring that back in. Now your capital number would be in this example $1 million lower, but the net worth calculation does not have that taken out. Just like OCI and different things that go into your net worth calculation that are not in capital. Now we go to year 2. What ends up happening is that net worth is only going to be increased by 66% of the transition amount, which means effectively you're only taking a third of the capital is coming out of your net worth calculation. Year 3, we go to 33% is going to be increased, which means we're going to take 2/3 of the effect of the transition amount. And so this example, we would have to reduce net worth by $666,000. Then year 4, it's completely gone. It all flows through your net worth ratio. So it's a 3-year stepped process. Year 1, nothing. Year 2, we only get hit by 33% of it. Year 3, we get hit by 66%, and year 4, we get hit with 100% of the CECL transition amount. So something important for capital planning, if you think about this, you'd much rather have a CECL transition amount than not, because it's effectively free capital that comes across here, especially year 1. Year 2, it's not completely free, but you don't want to have excess. I wouldn't want my current allowance for loan and lease loss to be greater than my CECL number. And I'd want to make sure you talk to your advisors and talk about deprovisioning. It's something in your accountants that may make sense to do. So you at least show up to CECL with a small increase. Much better position to be in. All right, so banks are a little different here in how they're implemented than credit unions. Banks take place over 5 years. Year 1 and 2, there's no impact at all. Year 3, you only get 25% hit of the CECL transition amount. Year 4, you end up with 50% hit, and year 5, you end up taking 75%. So they write it the same way as credit unions, where 75% of it doesn't flow through, only 50, and then only 25 doesn't flow through. So it does take 5 years here, so just slightly different. But again, it's important. We're coming into this, I'd much rather have a CECL transition amount than not. So with this process, it's really important we're all prepared to go. That's why we've had to make sure that we have June 30th all wrapped up and good to go, and July and August working very quickly on, and now September. We really want to get everyone's September's reports done in a timely basis. But part of this, to be able to get things done on a timely basis, we realize we need to modify how we are doing things. And so we've built a new online CECL model where you can come in and work on your CECL report whenever you need to. So super excited about this, and I'm going to go through the process, then we'll go through the example. So the steps to achieving CECL success is you have to upload your data to us. It comes to our client portal, and this data needs to come over again very quickly. Not with your ALM data. We need it well before your ALM data. We need your loan file, your detailed loan files, your off-system loans, individually evaluated loans. So these are any loans that have issues, and these issue loans are all just listed there, the loans, the dollar amounts, and then how much you set aside for each of these loans. We also need your balance sheet. We need a balance sheet to make sure that we can total back all of the loans to your balance sheet. So really important we get that data uploaded through our secure data portal. What happens then is we're validating it. We're going to make sure that it all balances. We're going to make sure that the balance sheet makes sense, the loan dollar amounts make sense, and that we have all the individually evaluated loans separated out. Really important process, because then when we do the calculation for the cash flow, to determine the weighted average maturity, we don't want to include, and we can't include, the individually evaluated loans. So at this point, we do the math. We calculate the CECL number. And what this is the historical losses. We're calculating the weighted average remaining maturity of each loan category, and then coming up with the historical losses for each loan category. And then we're projecting forward the historical losses on a forward basis, so we can see what our baseline calculation is for losses. And we're calling this as our calculation packet. This packet has all of the calculations to show the history, to show where we are, and show how we got to the number that's set aside. Now this ends up, and we're going to go through where our ALM 24/7 online demand simulations are, and our peer analysis. It's all in the same spot. And you'll be able to log into our web app and get to this today. If you have not gotten into our web app or you need help, please reach out to your advisor or the CECL team. They'll get you in. If anyone in your team needs access, we're happy to add them. We have a great process with putting people in and their passwords and making sure it's secure access just to your individual people that you want at your institution. Now, step 2, we're going to calculate the economic assumptions, and we're going to put those in the report, and they're going to be there. They're going to be part of your CECL calculation packet. And then the next step, again, as we talked about earlier, is we need to work with you and have you take on the responsibility of putting your current conditions adjustments in place. And so we need to make sure that these current conditions are updated on a monthly basis and that they're reviewed on a monthly basis. Again, our current conditions updates, the 4 basic ones that we have, and you can modify and put in here different things in these also, especially the specific client or regional adjustments, the warm term, 60-day delinquency, and percentage of loans in non-accrual status. I'm going to show you guys how we modify that. Once we're done with that, we can print our CECL report, the summation, we can print our calculation packet, and then all of our current condition adjustments are saved as a starting point for next month. So once you finish putting in your current condition adjustments, you hit the record button, they stay there until next month. You can modify them again, then hit the record button. There is a record button, so we know it's the quarter end or month end report. If you hit it and you make a mistake and go back and hit it again, that's fine. It's just making sure we know which one was the last one, so we have data for the next quarter. So, and also you can save all sorts of assumptions. Pretty excited about that. So with that, we're going to go through and get into our online demonstration here. And I'm just going to close this out real quick. And I'm going to share a different screen here. All right. And share. There we go. All right, guys. You should see now our dashboard. And so we're using the wonderfully named, I apologize if I look to my left, it's on my other screen here. What we have here is the dashboard for our online web app. And we have our different things down the side. We have our home button over here on the left. We have our ALM simulator. We have our peer group analysis. And then this next button is our CECL grouping here. So super excited about this. It's a very simple online interface with really 2 pages. The first one here is based off of current condition adjustments and modifying those. And the bottom of the 2 here, as we just scroll down a little bit, are the balances so we can see the actual effect as we modify the current condition adjustments. So as we get in here, let's just look at this and we can see one other thing. We do have our calculation packet. I want to show you this. We click on this wonderful spot here and it picks up and automatically downloads our calculation packet, which you guys should see now. And this is live too, so it's this is the speed it's going to work for you. And if it doesn't work, it's going to look really bad. But this goes through, and this has our calculation summary, our segment reviews, our loan balances, historical stuff, net charge-offs, recoveries, all the data that we have, all the information where we can go back and we can pull in all of our historical current conditions and everything here in your report so you can see them. When we get to the bottom of this report, we also have the unemployment data here to have that backup information. But we get to the back end of the report here, what does this have? Well, this is where we're doing the actual CECL calculation. And we're looking at here is this balance, really simplified here, 100,000, but we have our balance and charge-offs and then our historical charge-off rate. And then we're running things forward in the warm projection to show what the losses will be on a forward basis. And so then we're adding all these together and calculating this up. And so this is where we'll get our life loss ratio, which is the first piece of our CECL number. And so I flip back to our CECL report. You'll see right here our projected life loss, which is A, is 4.032, which is our starting number. That's our factual, if our loans fail at the rate that they historically have, this is what we need to set aside today. Now, the second thing we need to do is enter in our forecast adjustment, or B. Currently, that's 0.15%, and that 0.15, it's coming, I believe, 0.16 here for September 30th. We're looking at a June report, so everyone knows, so it's going to modify. And this is because of economic conditions deteriorating a little bit, that the number gets a little bigger. Now what we get to do is put in our additional reserves. And we might want to say, hey, our delinquency is up a little bit, so I'm going to put in 0.25%. And you'll see my total over here goes up to 0.25. And so I have additional current condition adjustments right now, positive $250. I'm going to say nothing for non-accrual, nothing for warm, but I am going to say, hey, our mortgages are really performing much better. I'm going to do a minus 1.25. And so here what we can now see is that my current conditions adjustment now is negative 1%. So we can modify those and we can see what then the dollar amount is here. This is the current adjustment dollar amount. Well, what does that mean to my total CECL reserve? Well, we just scroll down a little bit here and we'll see again mortgages up to 15 years, the example. We will have an individually evaluated loans filling in here. This example does not have any individually evaluated loans. Now we have our total CECL factor at 3.182 and our reserve of $3,182, which gives us our current CECL reserve. And then what we're going to have here is your previous month-end reserve, so you can see the difference. And so what this allows you to do is modify these amounts any way you want. And just to see that we do this on the fly, if we make this negative 2.25%, we're now down to 2.182% as our CECL reserve. So this gives us the capacity to play with our current condition adjustments, make sure we're up to date with them to get us the proper CECL reserve in the end. The kickoff of this, I know you've been spending a lot of time with the online version or the paper versions that we've been going back and forth, the input sheets. This is going to make it much easier so we can go in and make these modifications. So with this, a couple other neat things on this page. As you saw earlier, I pushed this button up here in the top right, CECL calculation packet, which downloaded that packet we looked at. The other thing we do is once I'm done with this, I can click this button right here, which is the export button in the top right. I click on that and I can either go to a PDF or to an Excel report. So you can have it in Excel version. So here we go, just clicked it and I'm going to pop this open. And here is our printed report. So you can save this, print this, put it on top of the calculation packet, and you have your reports. So really exciting to get that. A couple other things, if you've saved any of your CECL runs, which you can load those runs. Maybe I want to do hey, what if the world falls apart, or what if things go really well? I can do that. Once I have those, I can click Select CECL, and it'll let me select the saved runs. And then when I'm done, I can click Save Results up here in the top right. Is this the final version for the company? Yes or no? Is this your quarter end? Are you going to say this is your month end, this is your final one? If you say yes, it records it as the final one. Don't be worried if you need to record it again. You can record it again. That can happen. Here, I'm going to say no and save results, and success, saved successfully. So we can save different results. You can name your results. You can name your simulations and be able to have them for future use. So with this, I'm really excited. What this is going to give everyone here is two things. One, you will have your CECL packet, which is the calculation packet, which has the basic information, all the backup information to give the regulators. And then number two, we have here, based off online, you'll have a printed report, which is the outcome, which is here's the amount that I need to reserve for CECL. In this example, 500,000 of loans, and I have my CECL reserve. There's no individually evaluated loans, and so now we're reserving $66,357. So with that, I'm super excited. This online version here is something that is really easy and smooth to work with. Just go to our website, click on the top right to log in, and that'll get you in here and give you the ability to get in. Once you're in, remember, it's going to take you to your home screen here, which again has the ALM simulator, the peer group analysis, and then the third or fourth thing on the bottom here is the CECL number. And as you see there, it does keep this saved. So I do have my assumptions in here. And again, it's easy to add any assumption you'd want to add along the way. And you'll see how it modifies and immediately modifies these numbers as we just went up $500 more. So super exciting. I think we've got some great stuff here, and our team is really proud of what we've built. I'm really thankful for our team, our ALM team, our technology team. They've all done a really, really amazing job. And with that, I think the last thing I want to share with everyone is I want to make sure that we're all ready for CECL. We're all ready for what's going to happen here on January 1, and we're all prepared for everything. It's really important that we're all working very quickly, and that we're getting our data over, and we're getting prepared to provide that data in a very, very quick basis, because we're going to need to get that data to get it back to you for call reports, and also to get it back to you for monthly financials. So with that, a couple questions that have come in. Let me answer those. When in the app, the questions in the app, can I save runs as an individual, or do they save as a company? The runs that you do and the assumptions you make save as the user, and that user can continue to pull those up. The user can share their information, share that, but it's saved by the user. So if one person, an analyst, wants to run some different runs, it won't modify someone else's runs that they're doing. Another question just popped in. How do I get access to the online system? Is it different than the portal? Yes, it is different from the portal. You can click on our website in the top right corner. You can get into our application, or you can get into the portal. If you are in the portal, you can go from the portal to the web application. And if you do need a login, please reach out to your advisor or the CECL team, and they'll make sure that you and whoever else in your organization that needs a login has it. Another question here from Tina. Do we need to download both the calculation packet and the outcome report? Yes, so we do need to have both. You can keep it. It'll be saved in our web app. You'll be able to see it there. It'll also be over in the portal, where you'll be able to have it, and for historical purposes, so you don't need to save it. We'll have a copy of it, but for best practices, it would take to have the calculation packet. Definitely need to save the, I'd say print, which is so old school. We don't need to print anything anymore. But you do need to save the outcome final CECL number. You're going to need that 2-page document to turn in and to provide to accountants and provide to regulators. All right, another question that came in is how long do you expect the time would take between uploading the data and showing in the model? This is a great question, a hard one to answer, but we're talking days at most, a couple days. And the reason being, it just depends on exactly when. If it's early up, it's early. If you get it in early, it's going to turn around faster. If it comes in later, it's going to start to get in with ALM reporting. But our goal is to have it to you next day. As we kick things off, it might be 2 days, but our goal is to get down very, very quickly. All right, another question came in. I don't have a CECL Calc button below the Save Results button. Okay, that's just because most likely the June 30th historical calculation pack was not uploaded. for your institution. I'll look into it and make sure it's uploaded. And that's what we have. The June 30th data is being uploaded for everyone now. July and August has not been uploaded. It will be shortly if you've completed July and August data uploads. Otherwise, we're focused now on September. And so everyone will be able to see their September in as soon as we have that up and available. All right. Question came in about loading up the income statement and balance sheet. Do we need the finalized version, or can a prelim be okay? Yeah, the prelim is going to be okay. Long as there isn't a material change in the loan balance, we'll be fine. A lot of people call materiality 5% of assets. So long as we don't have a substantial change in the balance that's sent to us, it is completely acceptable for us to go with a preliminary balance sheet. Again, you won't truly have a final balance sheet until we give you a CECL number anyway. So it's going to be a bit of a process to get there. All right. Another question came in: are there changes in the report from August to June? So the report data, there are changes. So there's some minor calculation modifications or improvements that were made. So there might be some slight differences, just a few pennies you may see in a report. You may see in your report if you're comparing one month to the next and everything else is constant, but minor changes. Of improvements, we had some great audits and some improvements were recommended. One of the things too, if we look at dates, is we're currently uploading all of June has been uploaded. July and August are being uploaded if you've had those completed. And if there's a difference there, I know Steve, you sent a note there, they don't seem to match. Give us a call, or give your advisor a call, or give me a call, and we'll walk through that and make sure. I just want to make sure we actually are, and not from your standpoint, I want to make sure that what's labeled as an August report is an August report, as everything gets uploaded right now. So a couple other comments that came in. Here's one here. Are we updating our numbers on the website in place of sending over files to McQueen? No, we need you to, at this point, continue to send over your files as we do. We need to take that loan level data, process it, run it through our system, and then calculate the weighted average remaining maturity and the historical losses. So we need you to continue to send that information over. On the individually evaluated loans, we want you to continue to send those over. As you guys saw in the demo, there is a spot for you to put in individually evaluated loans. One of the things that was important is if I forgot by any chance to put in an individually evaluated loan, that we don't have to go back and rerun the whole process. We can just add the dollar amount in and then the reserve amount also, and that will update your CECL calculation. As long as it's not a material change, that'll work. Eventually, we're going to modify it and continue to have your capacity to upload those and make things easier. That is in process right now. But as of now, continue the same simple process. Upload your loan data along with your individually evaluated loans, and on a quarterly basis, your losses, and this will all get calculated, but you will have the capacity to make those changes. All right, and with that, we're coming to the end of our questions, as I see. I really want to thank everyone. Our next webinar is coming up actually tomorrow, which is going to be industry update for planning and budgeting. It's hard to believe it's October, guys. This is flying by, but we've got our predictions for interest rates, the economy, everything there, so we can be prepared for any modifications that take place in this world, and talk a little bit about loans and deposits and non-interest income and what's happening in the transaction world. So with that, really appreciate the relationship. Thank you for the business. We're super excited as we roll this out here, and as soon as we get your 930 data, we'll process it and get it up there. And then feel free to give us a call, give your advisor a call. We're happy to hop on a call and walk you through the steps and make sure we're all seeing this the same way. And we will have uploaded all of your historical individually, your historical current condition adjustments, so you'll see those there as a starting point also. So with that, thank you all very much. I'm going to give everyone about 25 minutes of their day back. I knew it wouldn't take a whole hour, but was really worth setting the time aside. Extremely important here as CECL kicks off. I want to make sure we're all comfortable, we're all prepared to move quickly and prepared to implement on January 1. As again, we have to have this done for January 1 for our December 31 call report. So a lot of stuff coming up. So thank you everyone here at McQueen Financial for all your hard work. I really appreciate our ALM team, our tech team, all the support from everyone to get this wonderful app up and running. And thank you for all of our clients again. Really appreciate the relationship. Look forward to talking with all of you soon. Thank you and have a great day.